Michael, welcome. Good to talk to you, and over to you.
Yeah, thanks a lot for having me on, Mike, and thanks for everyone who's taking time out of the day to come as well. I'm sure, yeah, especially now with the market heading upwards, there's yeah, every bit counts, doesn't it? As a trader, I find in times where the market is going up, the more time I spend at my screen, not necessarily staring at level two screens, but researching things and looking for new stocks and going through charts, directly correlates to my P&L. And I don't know if that's the same for investors as well. But yeah, grateful for everyone taking time out of the day to come. Hopefully, I will be able to deliver something of value. That's my goal anyway. But many of you should already be familiar with financial statements, given that they are, well, a significant piece of investing. And I'll be looking at all three of them in this. We'll cover some topics that I use to work out different types of trades, because not just charts. As a trader, I'm basically looking for anything that will move the price, and it doesn't really matter what that thing is. So, the typical reaction to a bubble is to short it because the price is wrong. But actually, sometimes the best thing to do is, if you find a bubble, go long, because the chances are everyone else is going to go long because people get sucked into bubbles, and that's how these things form. Obviously, they pop eventually, and you do need to be aware of that. But shorting a bubble is incredibly dangerous, and what is known as a front side short, where you would short into strength, which is incredibly high risk. And I think it's insane. Um, you have to be very advanced to do something like that and be very aware of the risks that you're taking. So, we saw in 2021, these hedge funds, GameStop was rising. People were saying, "Oh, this company's worth 10% of what it's worth now." For example, I'm not sure what it was worth and what it is worth, and they would short on that basis. But there's the value investing dude Benjamin Graham said, in the short term, the market's a voting machine. In the long term, it's a weighing machine. But you can be very wrong in the short term. You might be right in the long term, but not if you blow up. A lot of people quote that quote about Mr. Keynes: the market can remain rational longer than you can remain solvent. Obviously, in Van Gogh's case, can remain irrational longer than you can remain alive. So you do need to respect the market, and I'm sure everyone here knows that. But yeah, shorting is very dangerous. Not something I would recommend for a beginner. But I do look at the financial statements for short trades, as we'll see. So we've got the balance sheet, the income statement, and the cash flow statement. So just for a quick recap for anyone not aware of what these are, balance sheets measure the financial health of a company at a specific point in time. So this is actually easily manipulated by delaying payments. So if you want to make your balance sheet look better than it is, and you've got a big payment a week within your financial year end, you just delay it 2 weeks and push it into next year. Obviously, you can't keep doing that unless you delay the payment like a full year. It's quite difficult, but in the short term, you can massage those numbers to make them look better than they are. There are lots of other tricks as well that you can use. Balance sheets must balance, so assets are equal to liabilities plus equity. We can simplify that because liability holders own a piece of the assets, so do the equity holders. So basically, it's assets equals claims. And you can use the balance sheet for trading opportunities. One of my favorites to do is to check cash and cash burn and work back on this. And this can be a driver of price. So we've got an example of a company that I shorted in 2022, I think it was. Haydale Graphene. Stock had a weak balance sheet. It was rapidly running out of cash. And so the capital, sorry, just turn that to silent. It clearly needed to raise, so there is an immediate catalyst there. And if we look at the balance sheet here, we can see cash and bank balances in current assets. So current assets are within this financial year, so typically liquid things. We can see the company had at December 2021, 3.8 million. And if we move on to the cash flow statement, we can see that the cash used in operations was 1.6 million, 1.575. So basically, we now know three things. Haredale had 3.8 million cash as of the 31st of December 2021, because we've just seen that in cash and cash balance, cash and available balances in current assets on the balance sheet. We also know it burns through 1.58 million every 6 months because these are interim results. So if we work that back, we're looking at roughly 250k per month. Obviously, it's not going to be every month because cash flows fluctuate. But if we just do a rough calculation, 1.58 divided by 6, that is what we would get. Now, we then get a trading update in May, and it says revenues for the year ahead of expectations, which sounds good. Someone wiser than myself told me to read trading updates and results from the bottom up. And there we can see that the company has put the cash position in there, 1.62 million at the end of May. So this is in June. We then have another one in July. Year-end cash stands at 1.2 million. So this was capital expense. Year-end cash stood at 1.19. Yeah, as of the 30th of June. So then we can work it back with 250,000 per month cash burn. So on the 30th of June 2022, Haredale had 1.19 million. And by the 31st of July 2022, if we subtract 250k, it would have 940. End of August, 690. End of September, 440. At the end of October, 190. And in November, the company is insolvent. So that is a very rough calculation. But here is the trade. So we got Haredale valued at 27 million on the day of the RNS. And it states, not explicitly, but using the financial statements, we got the balance sheet and the cash burn and subsequent RNSs, trading updates where they've updated the cash position. It states that they'll likely be out of cash within a few months. Now, is this free money? No, because nothing ever is, and things like this aren't guaranteed. So the risk is the company puts out a rampy RNS and spikes the price. A lot of small cap companies can do this if they were looking to raise. I call them fluffers. They will put something out which will, make people buy. They might put out an immaterial contract through RNS Reach if they've won a big name customer. That contract might amount to very little, but the customer name gets traders in and people excited and spikes the price to then get a bit of interest to cover for a placing. And what we are looking for is asymmetrical risk to reward to short the stock and covering the placing. So you can see the entry here on the day of the RNS. I started going short when I realized that in a few months the company would be out of money and therefore raising. And not even that long, 2 months afterwards, or 6 to 8 weeks afterwards, the company raises money at 2 pence per share. So starting shorting at 5 pence and buying back at 2 pence gives 3 pence per share profit, roughly. So a 60% return. Now, obviously, this isn't a risk-free trade, as I mentioned, because going short, hypothetically, your risk is unlimited. If you're a retail client, it's limited to the capital in your account. But if you are a professional, then you're on the hook for all losses. It did come with warrants as well, which was quite tricky because I had to ask if I would be short the warrants with IG or short the open offer. there was a bit of a query there. They actually weren't sure, and I had to tell them what the right thing to do was. And in the end, they let it go in a way that was better for me, and I just let them, because why should I tell them if they're wrong? Obviously, if it was against me, I'd definitely be sure, but I did log it in the interest of fairness, and they decided to make it in my best interest, which was fine. So that is how I would do a short based on the balance sheet and the cash flow. You're looking at cash on the balance sheet. You were looking at cash burn. If it's the interims, you divide it by 6. If it's the full year, you divide it by 12 to get cash burn per month. Work it back, and you see when the company's out of money. And then, if it's more than 12 months away, it's probably not worth a short. If it's in 3 months, short the company. And then DM me and tell me as well. So just in case I've missed it. But that is how I would do, and how I do that trade. There's a company I'm short of now called Argo Blockchain, based on similar 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 the way to play the trade. Obviously, that is not a recommendation to go short, but if you look at the financial statements, this is the method that I've used to construct that trade. And I've actually written about this on Twitter, so if you go on Shifting Shares Twitter, you can read about it. So we come on to the income statement next. And what are these? And it's the financial performance of a company. It
Sorry,
provides
Michael,
results.
could I interrupt
Yeah,
just before we go on to the next example? I was just wondering
yeah.
how often in your experience, in a typical year or something, would you find opportunities like that? Haydale, can't say it, Graphene,
Haydale
where
Graphene.
it's a racing certainty they're going to have to raise cash because they're burning through what they have and they continue to be loss making. But there's still quite a, you're never quite sure how that's going to be raised and at what price, presumably. So what are so there's two questions really. How often do you
Yeah.
see scenarios like that in a typical year that give you the opportunity? But also then, what are you thinking through in terms of scenarios? Because you can't predict exactly when they're going to raise the
Exactly.
cash,
No,
and
it's a
you
very
don't know
rough.
in
Yeah.
how they're going to raise the cash, and you don't know what price they're going to set.
Mhm. Yeah, both great questions. So the first one, how often do I see these opportunities? There are quite a few. There are quite a lot. It's quite frequent. Is this one of my more regular trades? No, because it is higher risk. And if it's not an immediate catalyst, then it's probably not worth it. But there is one company called Zeros Technology. I think I've done this exact trade 2 or 3 times, because the company would raise, but then it would say we need to raise money, 6 months, in 6 months, or within the current financial year. So straight away, you don't even need to do the work. They're going to need to raise, which means one, no one's going to be buying if they know there's going to be a discounted placing, unless you're a complete newbie and you don't know how to read financial statements. But if you're a seasoned investor and there's going to be a discounted placing, you're probably not going to buy the share. Also, it's like a green light to short it, because there's going to be an event where you can cover, or at least as a catalyst to drive the price down. So it's not. I would say probably 5% easily of my trades are like this. Um, but when you find one, it can really work quite nicely.
Mm -hmm.
And
And
the second question
was more about then, given that you've got an opportunity, how do you assess the risk reward scenario here? Because you've got lots of unknowns. They're going to raise something at some time in the near future, but you don't know how much, and you don't know what price, and you don't know the process they're going to go through. So
Yeah.
you don't know how long you're going to have to cover your position for, and so on. So what goes on in your mind? What likely scenarios do you think about?
So in the case of Haydale, they were valued at 27 million, and the revenues were terrible. So you would look at price to sales, because a lot of these companies just aren't profitable, so they don't have a PE. You look at potential catalysts to drive the price. If they're growing revenue at 100%, then, using that cash burn may not be correct because they're growing revenue a lot quicker. You were looking at the chart as well. I don't really want to go, I very rarely, if ever, go against the trend on something like this, unless I think the trend is going to be started by that specific RNS. So valuation, price to sales, catalyst, history. Most placings are not done at a premium. So you can set a stop loss on the trade itself and think, is my risk to reward on this trade good? What the downside compared to the upside, and every trade is different. And again, it depends how much runway the company has. So, for example, PodPoint, I think they will need to raise because the amount of EBITDA losses that they have for the cash that they have and their revenue run rate, their revenue is not going to, in my opinion, of course, it's not going to increase enough that they will have that cash without needing to raise. The issue is they've got at least 12 months of cash. So me shorting now is bad risk to reward because they have got 12 months to, sign some fancy contracts, get the price. I mean, it's a bull market now, so it might even start going up. And yeah, that 12 months is just far too long. These ideally are short trades. You want them to be complete within, a few weeks or a few months. You don't really want to be short for a long period of time.
Okay. Were you surprised in that particular scenario that they discounted the price that heavily, or?
Well, it's a terrible company. Well, it was. I don't know whether it is now.
Yeah.
But it's a terrible company. The run rate was growing very poorly. And at the time, October 2022, the market was starting to turn downwards. Is there going to be a big appetite for placing? Probably not. Capital taps turn on and off. In a bull market, people write checks for any old garbage. When it's a downtrend, people don't want to part with the money unless it's a really good example. A really good opportunity. Surface Transforms was another one. When they did that placing before this placing, I was thinking they might need more money. I don't think this is enough. Maybe I should go short, and if I had, then great. But I didn't. There was another one. There was another one the other day. I don't think this has been released to the market, so I'm going to keep my mouth shut.
Okay, you might be inside on that one. Okay, we've got some
so I will
questions
keep
coming
shut.
in. Robert Aubrey says, you mentioned that for retail accounts that the maximum loss when shorting is all the money in your account. Does that mean cash or cash and any equities in your account?
So it would be the value, the equity of your account. Yeah, you can't go into negative equity. So it would be equity, which is cash plus or minus P&L.
So if you're holding equities can you hold equities in a shorting account as well?
So the only way to short is through a derivative, which is it would either be a CFD or a spread bet.
Right.
And they're both leveraged accounts where you have cash and positions. You can't go into negative equity. So let's say you've got 5,000 in cash and you've got 5,000 in Vodafone. So yeah, you got 5,000 in Vodafone. That would probably give you an equity of actually 5, unless that Vodafone stock was 100% up. If it was 100% up, then you've got 5 grand of additional equity, because it's your P&L. So it's fun, cash in the bank plus P&L. But yeah, everything in that account you can lose, all the equity in the account. So all the cash and whatever your P&L is added to that, so the equity.
So most when you say shorts, you're talking mainly CFDs or
spread bets.
Or spread bets.
Yeah.
Right, that's what you're talking about. Okay, fine.
Yeah.
There's a question here from Mark Lauber. He says, what percentage of your portfolio would a typical short trade size be?
Less than 5% easily.
Yeah.
I mean, these are quite high risk trades, but some of them are just quite small, and therefore you were restricted by one, the amount of borrow you can get, but also the amount of borrow that you actually want to short. Because if you're short something that doesn't really trade very much, and suddenly you've got a spike, then it can go against you quite significantly and overshoot what you originally intended to lose. So yeah, I would say shorting is quite high risk.
Right.
When done correctly, it's a great risk to reward, but it's also a great way to lose a lot of money quickly if you do it wrong. So yeah.
So you have to stay awake with that one. Okay.
And yes and no, it depends on the opportunity. So, again, coming back to Pod Point, I think the reward on that is nowhere near good enough for what the risk would be.
Yeah.
So I would just leave that well alone, even though I'm pretty sure they will need to raise, but in 12 months that it could even be at a higher price.
Yeah.
So you
Yeah.
could be right, but you might end up covering at a loss because the price went up in the meantime.
Okay, thank you. Andy Clapham just chips in that Moment Haydale are currently trading at 0.4p if anybody wants to buy them. So
I've got no idea. It's completely off my radar.
okay.
But generally, the smaller the company it gets, the less likely you want to short it because, I mean, yeah, it doesn't take much for a 5 million company to double and then it's 10 million. Whereas if you're shorting something 40, 50 million, you've got a bit of built-in protection because the company needs to increase a material amount in value before you're 100% offside.
Good point. Okay, sorry, I interrupted. Do we
That's
want
all
to go
right.
back to the income statement?
Yeah, always happy to answer any questions. So the income statement, it provides results for the specific period, also easily manipulated by capitalizing costs. So that is the old switcheroo of taking a cost and making it an asset. So there's one example, I can't remember, it was some dodgy mining company. It was worth 2 million or something small, but they had 30 million of NAV. And when I looked into that, because that sounds quite attractive, right? It's worth 30 million, but you can buy it for 2. When I looked into that, what it was is they had development drilling costs as an asset on the balance sheet. And the reason for that was because they thought it was an asset that they'd explored the whatever it was they were drilling for. I mean, I would just say you've lost money by putting it into the ground. They didn't seem to think so. So the accounting is really, you can hide things and change things quite easily. And that's just one example. Software as well. You can say, oh, we invested in our software when really it was necessary to keep the software running. It's two different. One's maintenance, one's growth, and management can classify it. But I mean, that's the subject of another presentation, and also one I'm not an expert on, so I won't go too much into that. We've got EBITDA, we've got adjusted EBITDA, we've got adjusted profit, and that is basically whatever management wants the numbers to be, they will adjust. Sometimes these are reasonable adjustments, sometimes they're not, so it's always on us to check. If exceptional costs occur annually, are they actually exceptional costs? Because you see companies where every year they've got exceptional costs, and you just have to ask, are they a real cost of doing business, and should they actually be in the adjusted figures? Income statements for trading opportunities. So are actual results ahead or below forecast results? Are expenditures shifted to the balance sheet? So an example here is McBride. This is a white label business that does like shampoo or something like that. I don't really know what it does. To be honest, I don't need to know what it does to trade it. Um, but everyone thought it was dead and buried based on the chart. You know, it had a lot of debt. It'd fallen from 240 to 20, so the market just assumed this was terrible. And then it comes out, the story turns positive. So we've got it's ahead. The full year adjusted operating profit and full year, if we can see here, is 5 to 10 million ahead of current market expectations. So suddenly they're performing better than the market expects. And if you look on the chart, this wasn't really priced in. So and then a month, 2 months later, we've got it's now materially ahead. So it's massively beating expectations. The net debt has also improved as well. So the narrative now is switching from McBride is dead and buried to McBride is actually doing better than everyone thinks. And if you look at the chart, the first arrow is the first RNS where it was ahead, and the second arrow is the materially ahead plus the liquidity being better. And we've got quite a nice rally and then a trend as well. And yeah, McBride is trading at I think 120 now, so it more than quadrupled from the lows. You didn't even need to look at the income statement because it explicitly told you it was materially ahead and the liquidity was better. So what I use to check for this is an RNS layout on SharePad, and if you use two green screens, you set up two green screens and you set the left one here to financials and then forecasts. And this will bring up the forecasts for the year. And when you have news, so this will be a news list, you get the full year results and you can then see these numbers have already adjusted because I did it on the night and the numbers, but on the day it was 2024. It's now updated to 2025. So next year, when 2025 comes out, in the morning, I will be looking at net profit and see if this matches up with this number here. And if it doesn't, then it could be a miss. And if it's ahead, if it's better, then it could be an ahead, and that would give a trading opportunity to intraday trade the stock. Does that make sense? Has anyone got any questions on that?
I think coming through at the moment, I think I get the gist of that. So, but
Yeah.
what kind of percentage change on the forecast numbers would make you interested in a trade one way or the other?
So if it's only like 1% above, then I may not be too bothered. But if it looks like quite a big beat and the outlook is positive as well, the management are coming out saying we're firing all four cylinders. It's been a strong year. The new year started even stronger. That would make me consider. Also depends on the chart. So if the stock has rallied strongly into these results, and the results are only in line, I'm definitely not going to be going long. Because the market may be expected ahead because the stock's rallied into this update. It's only in line. Then it could fall. Would I go short in a bear market? Yeah, maybe. Games Workshop was one that I used to like to short when the results would come out, and it would be in line. But
So that
yeah, ideally,
even with results in line with the forecast, if you've seen the price move over the prior period upwards, you seriously think about a short at that point, would you?
yeah, if it's rallied strongly and the results are only in line, the stock has already made its move prior to the results. So the way I see it, are people going to be buying this stock
Yeah.
now when it's in line, after a move? The answer is probably not.
Yep.
Are they going to be profit takers on this move? Potentially. And are there other people like me looking to short this stock, which would provide extra pressure and in the meantime help people take some profits because they see the stock price going down and get scared? So that would be my thinking. And depending on how far the stock has moved up, how far it's moved down, how big a beat it is it materially below or ahead? Is it, or just slightly? If it's slightly ahead or slightly below, I'm probably not going to do anything. Unless it was materially ahead last time and now slightly below, because that's a big change in the narrative. So that also matters. So in this example with McBride, the narrative had dramatically shifted. And so that is really the trade. That's what's going to drive the price. There was an RNS in 2017 from Boohoo. I had a broker call me up saying, "Oh, a lot of my clients are buying because the stock is usually ahead and then selling." And it was ahead, and the stock dropped 30% in a day because the expectations had gotten so high, it just couldn't be matched because it was ahead every single time. And then eventually it was ahead too much. It's after the fourth or fifth ahead, it's not really a surprise anymore. So is it really in ahead? If you're going to trade ahead statements, you want to be early to the trade. Same with profit warnings. If it's the first profit warning, it's going to fall a lot. If it's the fourth or fifth profit warning, that risk to reward is getting more and more against you as you continue along the story. So I guess what I'm trying to say is don't be a Johnny come lately if you can help it, and always look to make sure that you are not a Johnny come lately. Because yeah, it might be ahead, the chart might look good, but if it's the fifth ahead, it's probably not going to be in your favor.
Okay.
But that is how I would look for trades, intraday trades or even swing trades. So, international greetings, or well, I think it's IG Design now, isn't it? IGR.
Hmm.
That was materially ahead a few weeks ago. Sadly, I closed that one too early, but that has moved quite significantly.
Right. Well, obviously, the speed is of the essence in this situation. I mean, how quick do you have to be in terms of trading on these RNSs when they come out slightly ahead or slightly behind?
Well, if you're an hour or two late, then the risk to reward has already moved against you if the stock has already, excuse me, already moved.
Yeah.
Um, so usually if I'm gonna trade something, if it's a set stock, I'll usually be in the uncrossing trade, and I might have some slightly below that as well, just to try and get get a smoother fill. If it's a sets QX stock and it's significantly ahead in the charts, been falling into the update, you want to be the first buyer. Or at least I want to be the first buyer. Does it guarantee that you will make money? Definitely not. Um, but it's certainly better to be first and wrong quickly than it is to wait for confirmation, because then you've already got people underneath you who might take profit and stall the price. In the case of IG Design, that didn't happen. But even then, the risk to reward is just going against you as the stock moves, because the later you are, the less it is in your favor.
Yeah. Yeah. Okay. Okay. Are you and where are you using Specialist Broker to trade these, or are you doing it on a platform, or what do you use typically?
So I use IG's level 2 dealer, L2 dealer, and then I've got an account manager there who I can call and deal quite quickly.
Right.
Um, then I've got Maybank as well. Don't use them as much now because they changed the algorithm that I used to override the Millennium threshold, which was basically an algo that would allow me to place aggressive orders into the market. With IG, you can't do that. So, for example, if Vodafone would open 10% up, it's definitely above that Millennium threshold for that sector. So if you wanted to get in the uncrossing trade for in this hypothetical scenario, you would need to call IG, tell them that Vodafone is likely going to uncross above the threshold, and ask them to call their prime. So IG would then call their prime, but a lot of the time they're quite slow, and by the time it's fixed, the uncrossing's already happened. So there's not really a great super professional broker. I mean, IG are definitely the best there is, in my opinion, and they do a lot of good things. But I mean, they make most of their money on Forex clients. So, stock trading's more of an afterthought for them, which makes commercial sense, right? If you're making most of your money from Forex people, you're going to look after them first and foremost. So
Yeah,
I don't
yeah,
blame them. I just wish it was
yeah.
better from my
No,
own selfish point of view. Yeah.
yeah. Okay, so and then just the same question as before on the Haydale one. In terms of the example you're showing us here, which is based on an unexpected movement in the announced profits. How often do you trade on those in a typical year? Are they more frequent and opportunities than you were talking about on the balance sheet one?
A lot more, yeah. So these types of trades from the open, quite frequently, several times a week. Um, and then I also trade swing trade breakouts, which might be triggered either through a chart breakout, or the trigger might be ahead of expectations, and it's the first one.
Right.
I'll be looking to get in early and then potentially average up.
Okay. Okay. Thank you. We've got some more questions come in. Just checking through these. How many positions, anonymous attendee, how many positions do you typically manage at any one time?
Less than 15.
Okay.
And the reason for that is because once you get over 15, it's hard to remember them, and you're just more likely to take your eye off the ball.
Mhm.
Personally, I would rather average up into good positions that are doing well for me rather than having a load of smaller companies. Um, that's just me. It's not necessarily the right way to do it. It's just the way I do it.
Mhm.
But also as you go above 20, you start to significantly correlate the tracker that you're trying to beat. And I get it. People, if they've got 100 shares, they think they're diversified. But I bet if you look at the FTSE 250, or you probably got quite a similar performance because you are going to track the market with
Yeah.
100
Track the
stocks.
market. Yeah.
Not saying that
Yeah.
you can't outperform, you absolutely can. But if you've got a position that's 0.5% of your account, is your limited time better looking for better quality positions? I would say yes, but that's a different topic, and everyone's got to do it the way they see fit. But for me, it's 15 or less.
Okay. Okay, thank you. In fact, Martin Thomas actually is, while I was asking the question, asked a very similar question. How fast do you have to trade before any news is already in the price? Um,
Well,
do you want to say any more on that?
if you get an RNS that looks really good, um, and you check 3 hours later and the price hasn't moved, that would make my spidey senses tick up, because why hasn't it moved? Have I missed something? Is this story not as good as it appears? Because it's unlikely that the market has missed it. I mean, sometimes it does, quite rare. Um, but there might be a load of buys going through, but the price isn't moving, and that would tell me that there is a seller taking advantage of liquidity. In which case, that could be an excellent risk reward, because you're getting the stock not at a premium really, because the price has stayed flat because of the seller. And then once that seller clears, the stock can then move up.
Mm,
Um,
mm,
it's not guaranteed, obviously. But sometimes that can be a nice trade. Um, yeah, hopefully that answers the question.
yeah. Okay. Thank you.
If
Harish
not, please let me
Shirani.
know.
Yeah. Thanks, Michael. One here from Harish Shirani. When there are times when the broker is not able to quote a price, do you ever buy at best?
No. And the reason for that is because if you give your broker a market order, you have given them a blank check to go fill you at any price. And that's exactly what they will do. And you might not like that price, but you have given them the authority to buy at any price. So to me, that's just dangerous because the price might be a couple of pence, a couple of percent higher. It might be 20% higher.
Mhm.
So I would always just give the max that I'm willing to pay up. Not I wouldn't always do that. So the problem is if you give a broker your max, uh, they know that's your max, and therefore, depending on how good the broker is, how good the relationship they have with the market maker, um, they might, you don't know, they might go in and say, can you do this? This is my max or whatever. You just don't know. So I prefer to always give less than what I'm prepared to pay and see if I get filled. And if I don't, then I'll think, do I want to pay more? So, for example, don't always give a limit that's like 20% higher. If you are not comfortable being filled
Right.
20% higher.
Okay.
Um,
I've got one for anonymous attendee again. How do you get into the uncrossing trade? Perhaps you want to
so you
explain to those
use,
who don't understand, perhaps as well, not familiar with uncrossing, what exactly you mean by that,
yeah.
or crossing.
So
Yeah.
on the London Stock Exchange, you've got two trading platforms. You've got SETS, which is Stock Exchange Electronic Trading System. So really, it should be called SEATS, but it's called SETS, and that is like FTSE 100, actually all of the FTSE, and it's the electronic order book where you can place trades directly onto the book, with direct market access, which is what I use with IG. And then
Yeah.
you've got SETS QX, which is sets, quotes, and crosses, which is market maker stocks. They do have some auctions throughout the day, but these are very poor and they're completely useless. So they might as well just get rid of them. Which is what they actually did with the intraday auction for sets, because that was useless as well.
Right.
But essentially, when in the auction, you've got it starts at 7:50, and this is the call period. So you can place trades onto the order book, modify them, delete them, and then after 10 minutes at 8 o'clock, you go into the uncrossing period. And this is a random 30-second point where the stock will uncross and match as many prices and trades together into one uncrossing trade, and then electronic matching begins. So if you've got, let's say you've got significantly ahead statement, the price is probably going to open up above last night's price. You don't know where it will open up, so you've got to put a limit in to what you're prepared to pay. What I would say is be mindful of the indicative uncrossing volume, which you will get on level 2. So, for example, if the indicative volume is 50,000 and you want to put 30,000 in, you're going to add 60% to the indicative volume, and therefore you could actually influence the price, which you don't want to do, or I certainly don't want to do. So I'm looking to place trades that are not going to affect the indicative, and that indicative will ramp up in the last few seconds because everyone waits to the last few seconds to submit their order anyway, and then you go into the uncrossing trade where it could uncross, the uncrossing period where it can uncross at any point.
Right. Okay. Thank you for that.
Sorry, I would just add, all of this information is on my website. So if you go to shiftingshares.com or you type in uncrossing trade, shifting shares or auctions, shifting shares, you'll come across it on Google, but it is there under shiftingshares.com, articles, trading, and then there's all sorts of articles explaining all of this.
Okay, thank you. Well, should we move on to your final example? Just keep things moving.
So we got the cash flow statement, which we were introduced to in Haydale Graphene. What are these? It's the cash movements of a company, again, for a specified period. There are 3 parts: operations, investing, and financing. So the cash flow of operations takes the P&L and adjusts to show cash generation or burn. And most importantly, it tells us if a business is self-sustaining or not. If it's cash flow positive, then it's generating cash from its operations. Doesn't necessarily mean it is self-sustaining, so for example, if it generates 2 million a year in cash, but needs to invest 5 million for maintenance capex, then obviously that's not sustainable. But yeah, that generally it tells you if it is, but you've still got to look at the investing and financing. These tell you how cash is utilized within the business, what it's spent on. Did it buy assets? Did it sell assets for cash? How's it financed? Big numbers in the financing can mean equity placings. And we do have an example here. Just for full disclosure, I am short Argo blockchain. So yeah, I definitely am talking my book here because I'm short. But proceeds from share issues there at the bottom. We know it issued 7.5 million in new shares and raised that net of issue costs. Watch out for warning signs. This is Burford Capital, and on the statements, when it put out financial statements, there was a big volume outflow of stock. So these 2 candles are down days, and they're both on very heavy volume. So those are what I would look for on the chart. But certainly in the cash flow statement, if you've got something that is negative, to avoid it at least, because it will probably need a placing, and that placing isn't going to be done at a premium. Usually it's not done at a premium. I mean, of the few premium placings I've known about, one of them was a scam. I'm not going to name it because I like my life and don't see the need for legal action. But yeah, if it's a premium placing, you have to ask yourself why that is. There was one recently actually with Nightcap, which isn't a scam. The major shareholders just wanted to be supportive and provide a bit of bullish sentiment to the price, and also they had big shareholdings themselves, so it was in their interest for it to be at a high price. But generally, placings are not done at a premium. They're usually always done at a discount. If it's a bear market, it's probably going to be a steep discount. If it's a terrible business, which is what makes a good business is a different presentation. And I do have a newly launched YouTube channel where I want to share things like this on my YouTube. So certainly any subscriptions, if you think that it is useful, are appreciated. And I also have a paid training course, the UK stock trading course, and my email is michael@shiftingshares.com if anyone wants to get in contact with me. But yeah, I'm certainly happy to answer any questions, and thanks everyone again for your time for joining.
Thank you, Michael. We've got a few more minutes if anybody wants to fire any more questions at Michael about what you've just heard, or maybe something completely unrelated to do with trading. You just as a matter of interest, Michael, in terms of number of accounts that you're running at any particular time to do what I guess I don't know. You do invest long in as well, invest and hold, do you, or is most of your stuff you're buying and selling on a fairly frequent basis?
So I'm buying and selling on a fairly frequent basis, but my
For
biggest
everything.
trades have been 6 to 9 months.
Right. Okay.
And I'm never buying a stock purely on fundamentals.
Okay.
I don't really care if a stock is the most undervalued stock in the world.
Right.
If the price is going down, it's not going to make me money. So I'm not really interested until that trend changes.
And in a typical week, how many hours are you putting into your managing your portfolio?
It really depends. So I'm going through the RNSs every day, so that's an hour. I'll
Hmm.
probably be trading something at the open. If I'm not, then I'll make sure that everything, is opening normally and I don't have to adjust any stops or anything like that. But then if I'm not immediately trading, I'll be looking at news from the morning of companies that I don't really know about. I might go on Research Tree, read the initiation, learn a bit more about the company,
Okay.
potential catalysts. Um, if you want to be good and do well in this business, you can have several sources of edge. You can have better, algorithms, which I don't have, or you can work harder, and that is always quite an easy edge to get. You just do the work, and work smart as well. If you have a system to follow, that you can trust in, and you can back it up with data, it makes it a lot easier to follow. That's taken me quite some time to learn. Um, but I'll always be looking at past trades. What are there any commonalities between my big losers? Why did I lose? Did I make a mistake? What happened after I closed a trade? If I'm finding that I'm closing my trades too early and the price isn't really pulling back, then I should be driving my winners harder. And that will change because in bear markets, usually that I should be snatching at profits more, whereas in early stage bull markets, yes, I want to rotate into new positions, but equally I don't want to sell out with potentially big early stage two stocks too early.
Mm.
Um, so and then after the market, I'll be going through charts that can take anything from half an hour to 2 hours, depending on how busy a day it was. Um, obviously in a bull market, there's more stocks pulling up on 52-week high filters.
Right.
There's volume filters. I'll go through my watch list. Um, so it's it's quite a lot of hours. And then on weekends, I'll be looking at other stuff related to markets. I mean, I enjoy it, so it doesn't really feel
It doesn't
like
feel
work for
like
me. But
work.
it's not like how the Instagram traders would have you believe. You sort of sit at the beach and do 10 minutes of tapping on the phone and the money falls into your account. I mean, it would be great if it worked like that, but yeah, it doesn't.
Yes. I wish. I wish. Yes.
Me too.
So that sounds fairly much like a regular job in that sense, then, a few hours every day.
Yeah,
Yeah.
well, it can be more. I mean, during COVID, it was probably 12 hours a day sat at a screen.
Wow.
Um, because I remember leaving the desk and the football league had been cancelled and all the betting stocks had gone down, so you couldn't really afford to leave your desk. Um, and because so many things were moving, and then after the market, you wanted to stay on top of everything. So in times of high volatility, you just have to nail yourself to the desk and be there.
Hmm.
Um, so yeah, it really does vary. I'm spending a lot more time now than I was sort of last summer because there's just more opportunity, and as a trader, you got to take advantage of that. And I
Hmm.
guess the same for investors as well, right?
Yeah. Yeah. If you think it's a good price, then you've got to keep an
Hmm.
eye on it and buy when it looks good. So, and what about taking a week on the beach now and then? Break from all of that. How easy is that for you?
Well, I get bored quite easily. So we do things like that. As in 2022, we went to Lanzarote for I think 4 days. And I tried reading books by the beach and drinking beers and all sorts of magical potions the barman made, and it was quite fun. But after 2 days, I was like starting to get itchy. So I was like jumping on management calls and logging on SharePad and
Really?
doing stuff. So and my wife said, like, you're on holiday, why don't you just take a break? And I was like, I'm bored and I actually enjoy this. So yeah. I mean, obviously, I enjoy other things other than stocks, but like to me, it's just
Yeah.
fun. I mean, I find
Yeah.
it quite fun.
Okay. It's become addictive. Okay. No, that's
Yeah,
great. Thank you
I
for
guess
that.
so. Yeah, I mean, if we go to the US, then I'm getting up, in the middle of the night. to trade the open and make sure there's nothing like serious. Like if I have bad news on a stock, I don't want to wake up and it's,
Yeah.
you know, noon in the UK or whatever, and the stock's down 50%. I want to be proactive. So it would just be irresponsible of me to do that.
Yeah. Yeah.
That's the way I see it. So there's good sides and there's downsides. When we went to Hawaii, I was going to bed and getting up at 11 p.m. Sorry, 11 a.m. Hawaii. I can't even remember I think it was 11 p.m. I would have to
Right.
be fresh for 7 a.m. in London, something insane like that. So there are definitely downsides.
Yeah, I can imagine. So, well, thank you for that glimpse into your life as a trader. The anonymous attendee has been busy. Firstly, saying thank you very much to you for your presentation today, and then saying, is any long trades here today, or short? So, I think what they're fishing for is a few tips or something there. But
Well,
as
I'm
far as I
happy
can
to
tell,
share a couple
so
of positions. I mean, I share them on my Twitter anyway, so
that's the
it's not
place to
something
look, isn't it? Really.
that I
So we
hide.
should.
But I mean, what I would say is that for example, I'm long with Fentra. I was long at 32 and it's now 60. So anyone wanting to follow me in is not getting the same risk to reward that I was.
Yeah.
And that's something, a lot of people will tell you about position after they've bought, and there's nothing wrong with that, but you just need to be aware of that. Um,
Mm.
am I looking at any at the moment? I actually share that in my newsletter. By the bull market, I'll usually share a couple of charts I am looking at if they break out. Can't think of
Right.
any at the moment. Yeah,
You
but
have to be patient. Wait for your opportunities. Yeah.
yeah, yeah, exactly.
Yeah.
Yeah.
Okay. Well. Thanks very much for spending an hour of your precious time with us, Michael. And
Thanks for having me on. I appreciate it, and thanks to everyone who took time out to join as
you're
well.
welcome. And yes, thanks to everybody who joined us. I love to get you back and hear a bit more at some point in the future. Maybe some
Yeah,
other
certainly.
topics that you can share with us. But that's been fascinating for me. I don't personally. I'm an invest and hold sort of bloke, so I don't tend to do what you do. But it was interesting to hear the story and see how you can make money in different ways from the market. So thanks very much, Michael.